In the summer, we had there were real concerns. I mean, the growth scare was going to be real, right? And then we would have potentially a recession, and in a recession, the Fed cuts rates a lot more than just 25 basis points. And it's like, oh, now the Fed's stepping up; they're starting to cut rates. Growth, that look for growth is better.
Hmm.
We're taking that. The recession is much less on the table, which means rates are going to be higher because a recession would not do good things to rates.
All righty, folks, we are extremely lucky to have the one and only, and dare I say, legendary economist, Claudia Sahm, with us. How you doing, Claudia?
Great. Thank you for having me. Thanks for the kind words.
Absolutely. The audience loved you. We were lucky enough to have you, I think, about 2 months ago. And I reached out after this latest Fed meeting. Again, we got the quarter point cut. Some would say a hawkish Jerome Powell, kind of a hawkish cut. And then everything went crazy. The Dow was down, or the market was down 1,000 points. 10-year note ripped higher. So I had to come back to you and say, what the heck is going on?
Yeah, well, let's see if we figure that out.
Very, very cool. So would you agree? I think it was Mohammed El-Alarian that termed it a hawkish cut. Do you think that's a fair call?
Yeah, I think that phrase had been even floating around before the meeting. I think there was a sense, that there's gonna be a cut. There'd been some signaling, they were probably done cutting or would pause here for a while. And a little bit of me thinks like, what does a hawkish cut look like? Yeah. And then the day of it, it's like, yep, that's what it looks like.
That's what it looks like. Yeah.
So they really, and I think where you saw the market moves are a whole other conversation, I think, are an important one. But just if you think about the Fed trying to make clearly communicate their where they're headed, they used multiple tools at their disposal to make that point. Right. So they even changed some of the language in the statement, which tends to be more set.
Yeah.
Right. Like they only go in when they're, and it's very like, you've got to read the tea leaves. And I mean, like the very small change was like adding the words to the extent and duration. I forget what the other second word was, but they added like this extra clause that just reinforced we're not necessarily going to just keep cutting. Right. There's, we have to ask ourselves, will we keep cutting? How often will we keep cutting? So it became a question, whereas that hadn't been, in the text before. And that's a document that the entire FOMC, in particular the voting members of the FOMC, all have to sign off on. So those kind of changes are made really together as a group and under a lot of deep thinking about it. And then we also saw the summary of economic projections, which is there at every other one of the Fed meetings. Each of the individual participants of the FOMC, voting or not voting, will put together a projection of what they think is going to happen in the economy on only a small set of variables, but the biggies like, GDP, inflation, unemployment. So they put together their own forecast for through the end of this year, in 24, 25, 26. I think they even had 27 in this one. I mean, they put in several years, a long run. And then based on those projections, they tell us also in that same document what would be the appropriate path for monetary policy. Like if they themselves alone got to choose it, and based on their forecast of what they think will happen in the world, here's what they think would be appropriate policy. And though that one line that are their projections, the federal funds rate in each year, the fourth quarter each year, that it shows up in a table, but it also shows up in what's referred to as the dot plot, because they just plot out all of the Fed officials dots in each of the years. I think it looks kind of like a Space Invaders,
it
like
does.
old school.
Yeah,
I think it's totally ugly, but it's one of the devices that the Fed created after the financial crisis to help it communicate its policy. And it's actually another tool. Like, a lot of people said, oh, Wednesday was kind of weird. The Fed cut by 25 basis points, which isn't a huge cut. And it was well telegraphed, but it's still, they cut by 25 basis points. They told us in the summary of economic projections in particular, the median official, right? So, because again, they're all doing this independently. This is not a Fed official vote or something. The median official said instead of 4 cuts next year, like they did at the last meeting, the median was at 2 cuts. So being less restrictive. And it's a little tough with the market reaction because a lot of these pieces all come out together at the same time. So the statement and the summary of economic projections come out right at when the vote does. But rates went up. Market interest rates went up on Wednesday. The Fed cut,
and Thursday
rates went up, and Thursday, and pretty notably. We're not talking like a little basis point here, little basis point there. Like, like they were clearly reacting, and there was also reaction in Powell's press conference that comes a half an hour later, and so and he is largely there to be a spokesperson for the FOMC, walk through their thinking, and it's not. It's interesting. In some ways, the SEP did exactly what it was supposed to on Friday. The reason, back in soon after the financial crisis and the economy was a complete mess and the federal funds rate was pinned down at 0. And the economy was still very weak, and the Fed was trying other measures, asset purchases, various ways to try to get some oomph going in the economy. And this part of the SEP's role wasn't the only one. There were a few other things that the Fed did in communication policy, but is to tell markets, well, we're gonna keep interest rates down low a long time. Like, we're really gonna help this economy get going. And so then the markets look ahead and they're like, oh, well, they're going to help way in the future. So we can be a little more buoyant on, and kind of help out here, right? Help hold down these market interest rates because we know the Fed is going to be a while, but like they're going to keep holding it down once they get the chance. If the Fed were concerned, and the Fed has some concerns right now, I think probably overly kind of getting a little wound up on the noisiness of data, but there were certainly concerns. And since the press, this summary of economic projections, so in September, a lot of the inflation data had been kind of disappointing up until November. November looked great for PC inflation, but in general, like things weren't coming. They just weren't making the progress on inflation that they had expected. And so, well, what do? You say, well, we're going to fight this inflation harder. And how do you say you're going to do it? Well, we're going to, not cut rates as much next year. And the market's like, oh, you're going to do that next year? Bam, let's do it right now. Right. And so they put it
got you.
And so like, it's exactly it. I think that listening to some Fed officials, like I was listening to Mary Daly speak, a recorded interview this morning, and the reaction looked big, right? She thought markets were prepared again, that this hawkish cut idea had been floating around before the meeting. So, but markets are unpredictable, and what narrative picks up, and I think and one difference was the press conference. Powell exuded more hawkishness than he has in a lot of, he's kind of saved the day on a lot of these kind of prior, kind of hawkish, is it hawkish, is it not, Fed days. And he very much, I think, leaned into concerns, not just about the inflation data. I think he probably sits in a camp of like, this will be noise and we'll move through it, but we want to see it's noise. We're not going to assume it's noise. Right. So I think that's fine. But there certainly are a lot of inflationary risks next year. There's just a lot in the policy space that could end up causing inflation, even if it's temporary.
Yeah.
So.
Yeah. One of the things that, and I forget what statement, it was definitely in the statement. It's kind of what sent the stock market down big after he kind of said this. It sort of seemed to me that Powell probably would have preferred to pause, but felt like he was painted into a corner given he telegraphed it was coming. And I think that the odds were 98% that a cut was coming. So he kind of felt trapped. Am I overreading it, or did you see some of that?
Yeah, I don't know. It's tough because when Powell speaks, he is supposed to be speaking for the FOMC.
Okay.
Right. And so, of course, his own views are he is the head of the FOMC. His own views will have particular prominence even among the FOMC. But when he's out there trying to explain, here's what we did, it can be difficult to really piece out. I thought it was striking and actually did add to the hawkish cut that he and other officials have said afterwards, it was a close call.
Right. That's what I mean.
Whether to do that slash 25. So whether it was a close call for him per se, or like listening to him talk, I didn't necessarily hear him being like, I didn't really want to go today, but we felt like we had to go today.
Okay.
I mean, the reality is like this what they have referred to this first phase as their recalibration. And I'm actually now finally getting, I think, better explanations of what this is as we're moving out of the recalibration. Which is typical Fed like. But it is the idea that, the Federal Reserve raised interest rates rapidly and substantially after they decided in early 2022, this inflation is spread, this is not under control, we have got to go.
Yeah.
We had 4 meetings in 2022 that they raised the funds rate by 75 basis points each.
4 in a row.
4 in a row. Yeah. I mean, like, so we didn't even cut 2 of those meetings off. Yeah. Right. Like, and the thing is the inflation rate, while it may be stubborn, while it may have been, disappointing in its the time it's taken to get it back to 2%, it is nowhere near where it was.
Yeah.
When we were at these peak inflation numbers. And so their point, and I think it was a valid one, was that they need to get recalibrated. Right. They had Fed funds rates that they had felt were appropriate when we were at peak inflation, and we were no longer at peak inflation. And the problem is those interest rates are putting pressure on the economy.
Yeah,
among the labor market, and it's risky. Like it is like it might be just fine, might work out okay, but like it is a cost that's a pressure that's being put on the economy. So I think this first phase was just a recognition of, hey, the Fed funds rate, we hadn't adjusted it yet. It's just too high for where inflation is. So it's this recalibration, getting it in line with it. And so in the end, they took a percentage point out of it. Mm-hmm. The peak funds rate was at 5.25 to 5.5 range. Right. So like really like this seems pretty appropriate, I think. And so it's a little bit like, no, it's not a little bit. It's really kind of splitting hairs. It's like, is 75 recalibrating or is 100 basis points recalibrating? And, they don't want to get bounced around too much by data that are pretty noisy. It may have helped that the PCE numbers were going to come in pretty well, reinforcing that things, you have your ups and downs. So I think, I was a little, I definitely noticed when Powell said it was a close call, but I didn't take it as a, like, I felt pressure. I didn't want to do. I mean, frankly, I think Powell has been pretty good at being able to move forward a lot of his thinking, which comes from a lot of consultation. So I'd be a little surprised if on something like this, you get rolled. But the dialogue was also really complicated. And he was like trying to just discuss a seam, right? We have this recalibration. That's why we've been lowering rates. It's important to not be too far off sides, in case something were to happen. But now we're entering a new phase.
Okay.
And the new phase goes back to a real, I don't want to say hyper focus. I mean, it is part of the dual mandate, right? Inflation, right? Like they should be important, but again, this real inflation is too high, inflation's not coming down. And it did appear that at least some of the Fed officials, when they're writing down their forecast, were thinking also about the tariffs, about other kinds of policy next year. And potentially that is a reason to, one, expect higher inflation, but two, most importantly, to hold off on rate cuts.
Well, that you've just exactly nailed why I thought they should have pocketed the December rate cut and just wait a couple of months, because again, there are some inflationary possibilities, right? We have tax cuts, we have tariffs, we have immigration. You know, there are things that, again, we don't know what's coming, and it seemed like one of those times. You know what? We're going to hold this one back. We'll use it in January, or we'll use it in March, or whatever the next two meetings. But I guess that's going to be what they do now, is they just sit back and wait. And
well, I think you can think that that recalibration phase was thinking a lot about where's the Fed funds rate now,
okay,
versus where did it top out, and what's an appropriate, like, how restrictive are we going to be? Like, the level of the Fed funds rate becomes very important in that recalibration exercise.
Okay.
So you want it to still be restrictive, but not too restrictive. I mean, this is totally art, not science. And your point could apply as well. But once you get past that, like, recalibration, now they're back in the,
okay,
you know, are we putting enough pressure on inflation to get it down?
All right, so we can put recalibration behind us. They whacked off 100 basis points, a percent. Now they're going to be much more attentive. Mm-hmm. Is that fair?
Yeah, it's so hard. Like, they're always so attentive to. I mean, it's interesting. Like, we're not in a moment. The other thing that happened, the other surprise relative to their September summary of economic projections, is the labor market steadied itself. Right? When we started this cutting cycle, you know, there's all this recalibration, and being confident that inflation is going to 2%. Yeah, I mean, they have all kinds of metrics, but when they actually started cutting, it coincided with the labor market, which had been cooling off for some time, kind of picking up some momentum. And the unemployment rate had gone up pretty notably. I mean, still small, but had moved up, you know, a couple tenths of a percentage point in a release. And we'd gotten some bad information, or some worrisome statistics on, like, the payroll employment was actually quite a bit less than what we thought before, and things were slowing down. So that part of the kick to get them to start cutting wasn't just that we'd had some good inflation prints, which we had, and that was going to be necessary. And we're gonna have to see some good inflation data before they cut again. I mean, like, that's pretty clear. We're back into that mode, which is fine. I think they're gonna have some pretty good inflation data here once we get some months into the year. But they also had this worry in the labor market, and the Fed never said they were cutting out of fear that the labor market was falling apart. We're cutting from a place of strength. We want to maintain this, blah, 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 which I think is the right justification. And I think that's what they were doing. But in the interim, well, the unemployment rate came down some, and the payroll gains have, you know, steadied out, at least the data as we have them right now. So then it took some of this pressure off.
Right.
So I think we're going to continue. I suspect next year we will see more of this, like, either, you know, some kind of a growth scare, or particularly in the labor market, things kind of wobble. And then the inflation data, and then it's kind of like, because they do have the dual mandate. So it's both pieces, and both pieces moved away since September of the cutting mindset, because labor kind of looked better. Inflation didn't look better. So I think I suspect to get them to really to cut, and particularly, you know, next year is going to be a lot of uncertainty about all this other stuff that's going on. They're going to have, I mean, they're the Fed, they're cautious by nature as an institution. At the end of the day, they're going to put a pretty high bar on cutting. the next cut. They put a pretty high. I mean, they put a really high bar on the first cut, right? So like that's just the way, because they have an asymmetric concern in that I think they feel like they can play catch up. Like, yeah, you should have gone the last meeting. Well, you can cut 50 basis points the next meeting. They've kind of done this, right? Yeah, you can catch up with the cuts. What they want to avoid is taking so much restriction out of the economy that then inflation takes off again. And then they have to chase it up with rates. Like they really do not want to raise rates. They'll see it as a policy mistake. I mean, it's a little weird because I mean things can happen in the world that would make raising rates the appropriate thing to do. That wouldn't mean it's a policy mistake, but they're very, so that adds on to the caution.
Yeah, when I looked at the dot plot, because there was a lot in there that changed. A couple of things that were shocking to me is there was apparently one Fed president who said no cuts in 2025 was a real possibility. And I think it was two that said only one cut. Yes, the median was two, but there was there's at least one person saying no cuts in 25, which is, something I put out there, a month ago, 6 weeks ago. What do you think about possibility of no cuts? Is it a zero chance or something non-zero?
So one thing that was really frustrating about this SEP, more than the frustrations of a typical SEP, is you had, and Powell told us this at the press conference, that officials differed in the extent to which they included assumptions or projections about the policy environment.
Correct.
So I could tell a story with a certain set of policy assumptions about, I mean, 25% tariffs on Canada, Mexico might get me there. But you could have a certain set of policy things where I'm like, yep, they're not going to cut next year.
Right.
Because there's inflation created. Maybe things will just be kind of frothy growth-wise. I could see the narrative. But if you told me that person that had no cuts also had put no policy assumptions in, was just going off the data, I'd be like, it wasn't that bad.
So it's kind of double assumptions, right? You don't know who it was, you don't know what they were assuming. That makes sense.
And I think it makes that SEP really complicated to use because I don't know what
kind of an outlier because they didn't do that the times before, right? We have nothing to compare it to.
Well, I think generally there would be a consistency in the assumptions. It's not, I don't think it's unreasonable. It's like the Summary of Economics, every official does it on their own. There's no pressure in what they write down. Their dot is their dot, blah, blah, blah. Even though it moves markets. The SEP works really nicely in economic theory, if not in reality. But basic conditioning assumptions. Now it's true, we don't usually have to make those because they're just kind of in the ether, but this is like working on the forecast at the Fed for many years. One of the very first sections in the front of the Teal book, which is a document we use to describe the staff forecast to the FOMC, one of the very first sections, and it's kind of a boring section, but it's right towards the front and it's really important, are conditioning assumptions. So things that come in, like their assumptions, definitely any assumption about fiscal policy, and sometimes they're even before they pass, right? The staff put in the Trump tax cut before Trump took office. So this December, but it was a very slim down. We're just going to put a personal tax cut in. This is a placeholder about the size, but it was well described. It was simple, so you could keep track of this thing in the forecast. And then later, as we got details about what the forecast or what the actual policy was going to be, then that got put into the forecast and you could kind of watch it. It was very clean. Like you can follow this thing over time. At this point, the SEP is just a mess.
Yeah.
Like until, if later in the year it's clear everyone's putting in the same, like we have to, and I think, something like with tariffs, we're probably going to have a rolling set of policy interventions.
Correct.
Right. So it kind of is a problem to not have the baseline right. But I really thought Powell was going to put his foot down and just be like, we're either not going to have policy assumptions or we're just going to have this one or something. Because it actually really doesn't do us. Yeah, like you said, there's so many levels to the forecast. And I actually don't really care what a Fed official's forecast of the tariffs is.
Right.
I care what they think that kind of tariff would have on inflation. And then the biggie that is very hard to pull out of the SEP, though I think kind of from the discussions, and Powell answers at the press conference, it's a really important question as to what the Fed does if there are tariffs, because those create inflation, but it tends to be temporary because it's about you're levying a tax on the price of that particular good. Well, once you get that levy, that level up, well, yes, you've had inflation, but then it's temporary, just kind of by construction, unless you have retaliation. I mean, there are cases where if you end up in a trade war, we've moved past a discussion of temporary inflation. It can be something much more ongoing. So there are differences in and that's why the policy assumption is very important. What you're doing, but as was the case with Trump's first set of tariffs when he was president the first time. I mean, the Fed not only looked through them in terms of not reacting, trying to fight that temporary inflation. At that period, the Fed was cutting interest rates because they were concerned about the outlook for global and for U.S. growth.
Right.
So it's really pretty, and there are cases, and Powell referred to this at the press conference. He had from the Teal book, the analysis, and there's different cases when the Fed would react, when they wouldn't react, and that's a really important nuanced discussion to have. And my read of the SEP, and I could be wrong in this, my read of the SEP was they didn't plan to look through this one. I mean, they wouldn't necessarily raise rates, but it is also a policy decision to hold off.
Right.
We don't want to be, and I think for a lot of reasons, it could be very tricky for them. The optics, the confidence, if they're worried about their people's confidence in them as an inflation fighter, to be cutting while inflation is higher, regardless of whether it's coming right back down. So it's there's some really, really important questions. Powell has not wanted to answer them, to engage in a discussion of the policy, which I can understand why. But what we get in the end is this document. We don't want to know what people are assuming. It's really hard to parse through. It has the answers, but it can't talk.
Right.
And it's kind of a jumbled mess to read it. So everybody can go in there and look and find, I think, what they think.
One of the things that I've been watching for really since Michelle Bowman put it out there months ago was, I think one of the biggest, as a novice, kind of just a general consumer out here, is where is the neutral rate? Obviously, it's definitely art, not science. Nobody really knows. But I am feeling, again, looking at this SEP versus past SEPs, that it seems like there is a gravitational pull that people are assuming it's higher than maybe they thought before. Maybe before it was low threes. Now it's high threes, maybe even has a 4 handle. Am I reading it incorrectly, or is that possible that the neutral rate's higher than they thought it was 2 months ago?
Yeah, there's absolutely been a drift upward when the summary of economic projections, the long run federal funds rate projection, that's what's usually tied to this neutral rate. And the neutral rate in as a theoretical concept is just, there's a couple ways to think about it. One, it's the Fed funds rate, which the Fed is neither putting upward pressure or downward pressure on the economy. So it's kind of like when all things are good, we're at the dual mandate, the Fed doesn't need to do anything. That's the interest rate. Another is where all the demand for savings and all the demand for investment in the economy, that's the interest rate that gets it to balance out. There's a lot of reasons at any given point in time, that's not like these tend to be what are long run or equilibrium concepts. Like everything else is fine. Of course, monetary policy is not made in the long run. Like monetary policy is made now. So there's a lot of like mixing of, I think, conceptually what people want. Like people, I think probably the Fed and definitely markets want to know, where's the Fed funds rate going to stop?
Right.
Like that's the question, and it gets looped into, oh, what's the neutral rate? And it's like these two things may or may not be the same, but at the end, I kind of, in some ways, I feel a little better with like the terminal rate, like the last place. Like that's kind of the practical where we're going. But this whole discussion, and I heard a commentator say, oh, 2025 is the year of the neutral rate, and I was like, oh my god, I'm not sure I can survive this. So, but it is, but interest rates, these are very interesting questions, and I mean, interest rates are such fundamental prices in the economy, and they really tell us a lot about the economy. So while over the past several months, actually at least the last 2 years, we've seen that long run interest rate in the SEP gradually like drift up little bits. Right? It's a long run concept. They don't do radical overhauls on the numbers. They're little, like a tenth, but when it's been revised up over this cycle, and it's come from the idea of like the economy has been really resilient.
Yeah, no question.
We've seen growth has remained strong. Like it was kind of expected. The Fed was never trying to tank the economy, but that big increase in the federal funds rate, all expectations were it would slow things down. Well, things didn't slow down. Now we have to remember that the Fed is just one of many, many factors hitting the US economy. So yeah, the Fed has been, the higher interest rates have been restrictive, but not enough to make up for the fact that the labor market has been really strong and income has been strong. And we had a stock market that has been pumping, money into household balance sheets. And, so you have all these different factors, but over this period, one, view people have taken as well, the Fed funds rate just really isn't as restrictive, because this neutral rate, this place where we're like balancing out, pushing up, pushing down on the economy, is actually higher than it was before. Now we've seen the median Fed officials long run rate move up. We haven't gotten a lot of commentary on why. Powell is not a huge fan of talking about R-star, which is another thing that the neutral rate goes by, because it's a pretty wily little concept. But it's notable that the estimates of R-star, or the neutral rate, they dropped a lot after the financial crisis. We went into a low growth, low inflation period. This was something seen worldwide. Not only was the Fed dropping their view of the neutral rate, they dropped their view of the potential output growth. So like, what's the trend growth, the economy? So what we're seeing now is we've had the interest rates, their interest rate estimate move up. There's quite a bit of a difference of opinion. But they haven't really moved any of the other long-term goals like output. So, but you can tell both in the SEP and in some of the discussions, including with Powell, that they are coming around to the level of the interest rate that they have right now isn't as restrictive as maybe they had thought.
Okay. All right.
Which would mean don't cut too soon.
Yeah, exactly. Yeah, exactly. Well, let's talk about the average consumer now, because again, the Fed has cut 100 basis points off of the federal funds rate. However, most consumers, certainly in mortgage, have seen mortgage rates rise 100 basis points. We're now over 7%. When they started cutting, it was in the low sixes. So what's an average consumer to think? What does that mean? What's going on? Obviously, the Fed controls the front end that the long end not so much. But what's an average American to think, hey, the Fed cut, why are my rates higher?
Yeah, I think, it's probably the one thing to say that Fed cut this last week, that was old news.
Yeah.
No, that was already in those prices.
Priced in.
Right. It was, and that really, and I think that's probably been, and it's a little, but I wouldn't just, it's also a good reminder, particularly something like mortgage, any market rate that a household or a business would encounter has more to it, a lot more to it than the Fed funds rate.
Correct.
And so you can have times where I think there's a fair bit of, there have been a lot of very interesting market interest rate moves kicked off this year by Fed action, right? So even if you think back to when they first started cutting rates, wasn't cutting the Fed funds rate, it wasn't too much of it. You saw market rates move up.
Yeah, no, it happened the same day. Yeah.
Yeah, and there's an aspect of, well, in the summer we had there were real concerns. I mean, the growth scare was going to be real, right? And then we would have potentially a recession, and in a recession the Fed cuts rates a lot more than just 25 basis points, and it's like, oh, now the Fed's stepping up, they're starting to cut rates, growth, the outlook for growth is better. We're taking that, the recession is much less on the table, which means rates are going to be higher, because a recession would not do good things to rates in terms of, end up bringing them down. So it can be a pretty complicated, like what the longer rates are looking at goes well beyond what the Fed is doing, because it's much more a reflection of kind of the health of the economy overall. And, but yeah, it doesn't, it doesn't make it an easy case. Well, actually, it doesn't. So it can make it difficult for consumers to be like, why is it like they're cutting rates and what I need is going.
Why do I got to pay more? Yeah. Exactly.
Yeah. It's like, this is not, this doesn't make sense. And then it also shows how difficult it can be for the Fed to figure out what it needs to do with its rates to have an effect on the economy.
Yeah.
Right. Because no consumer or business borrows at the Fed funds rate. They're all borrowing out in market rates. So it's like really it's a very messy, we call it transmission mechanism between the Fed, the markets, and the real economy.
Yeah, well, one thing we've clearly seen, you can go back and look at the data month by month, at least on existing home sales. I think the trend is very clear. When the market rate for mortgages gets close to 6%, demand picks up. And when they go over 7%, demand tanks. And today we're sitting at 7%. And actually, I think there's a decent chance that mortgage rates are over 7% on average for the year next year, which again is impacting, average consumers.
Yeah.
Yeah.
Absolutely.
Yeah. So again, I think it's going to be interesting to watch, because again, with rates over 7%, it's going to be a drag on the economy. Real estate's a big part of the economy. Small and medium-sized businesses who don't have the balance sheets to get cheap money, 7% capital investments, cost of capital where it's at today, I think it's going to be restrictive on the economy. Is that reasonable to think?
I think, and then the distinction you made about different parties' ability to access different kinds of capital markets, right? Like, we're not all one consumer.
Correct. Yep.
But yeah, no, I think with the Fed on track to be slowly cutting interest rates and the market very attuned to that, I don't expect the degree of restriction to ease up much. So that means, and I mean, that was part of the reaction to in markets, like seeing companies and, some of the biggest losers in terms of equity prices since the Fed meeting were the smaller cap.
Correct. Small
businesses.
Cap.
So when you think about businesses that need to go to the bank to get money, can't go to the market
Yeah.
and raise capital. That's a group of businesses and a large group of employers.
Yeah.
Who that puts some pressure on them. And I think one of the other pieces with there have been a lot of kind of expectations about, we're getting inflation under control. The Fed is going to be cutting rates. And, this idea of businesses planning ahead. Well, we can make it just another 6 months and then rates will be lower and we can do the borrowing that we need. So the higher for longer is like there's pressure on the economy, and then it's that aspect of the continued pressure restriction.
Yeah, it's the duration that becomes a problem, right? And again, we're starting to see that kind of second or third tier company who maybe was hoping for lower rates to borrow. I think we just saw Party City, and we saw, I don't know, there was another one that just went out. I have it in my notes here. Oh, Big Lots, right? A couple of big retailers probably should have been out of business already, but we are starting to see, people who maybe would go to banks or other places, they can't borrow and they're just shutting their doors. So if rates are higher for longer, and again, small and medium-sized business, my understanding is they're the largest employers in mass. This could lead to more job loss heading into next year, or what do you think?
Absolutely could. And we've seen, and the Fed acknowledges, the labor market has cooled down. It's been a gradual, I think they call it orderly process, which is pretty remarkable. But I mean, it is an accurate word. But it has slowed, and it continues to slow. Right. So, and then that's kind of this, well, how is the labor market not going to have a problem then? Well, it's like, no, it's like, so you have something that's in a, not weekend. I mean, the labor market is still in a relatively good place, but it's nothing like it was in terms of 2 years ago. And you're continuing to put pressure on it. And, but there is also, I mean, a somewhat more positive outlook, and one that, again, markets like to look ahead, and they're trying to figure this stuff out earlier before, the Fed decided to get in the mix. There was this big discussion around, the Trump trade. So President Trump coming in, there was a lot of policies, not the tariffs, but policies around deregulation and maybe some more tax cuts, things that could be particularly beneficial to small businesses. And you've seen some business sentiment surveys, which you got to take with a grain of salt, but I mean, you've seen some with some pretty notable pop. Yeah. But there was one that I'd look, because I mean, I've been looking at the job hiring rate, which has fallen back quite a bit in the United States, really to levels last seen coming out of the Great Recession. So, I mean, not like good at times where things. Now, the layoff rate right now is like really low. So we have this strange setup of like a very low layoff rate, but a low hiring rate. So businesses are basically hoarding their workers, and they're very cautious about taking the new people on. It's like, okay, fine. There's uncertainty, and you could think about, well, maybe what would it take? Because the thing is like those two things aren't going to stay true forever. Low, because one of the two is they're either going to move to each other. You're either going to get the hiring rate comes up, or the layoff rate comes up, right? And so looking at some of these business surveys, especially the small business one, it's like, oh, this is general broad-based surge in sentiment, but they do also the National Federation of Individual Businesses,
NFIB, I think.
Individual. Anyways, everybody is a small business. Independent. I was like, not individual. Yeah, independent. That they also ask about hiring plans.
Yep.
And those really didn't improve much.
No, not much.
After the end of the election, a little bit. But it's kind of like, trying to figure out, like, why is that hiring rate so low? And there's a lot of different discussions, or a lot of different reasons you could have it. But we could also have some of the policy. I mean, there are policies on the table that could help growth at business. I mean, that's certainly
for sure
how they're being promoted and have some pieces, but we don't know. We also don't know that, like, how that's going to resolve.
Yeah. Well, let's talk about your base case for 2025, if you don't mind. I guess I'll start with interest rates, kind of where we started in this. Are you kind of on board with the Fed likely to do 2, given what you see potentially coming, or you above or below that, you think?
I see more than 2 cuts next year, but that's so conditional on a benign tariff environment. Like, I see the tariffs in a fairly target, like the way they actually end up, not the discussion of them, the way they end up, relatively targeted, something closer to the last set of tariffs and not trade war.
Yeah.
So I've got them kind of running, and I still see the Fed looking through them.
Okay.
Like, and treating them kind of as, this is a temporary, we can identify this and point to it. And so that means much of my thinking is, one, the recent inflation data that was somewhat disappointing. I think that's going to be a flash in the pan. Okay. And we're going to move into this year. And we've got some, we have the potential early this year to make some pretty quick progress.
Yeah, the base effect.
2%.
Yeah, the base effect is real. I mean, if you look at the chart, the base effect, you could be under 2% by April or May. You could.
So I don't think we'll get that lucky, but and the other piece is labor market is not out of the picture yet. Right. Yeah. I'm more concerned that we see something line up a little more like last year, where we're uncomfortable with how much the speed at which labor market is cooling off.
So you're more concerned about labor than inflation in 25.
Well, I think to get them to cut, right, again, there's going to be a lot of resistance to cutting. And I mean, honestly, it's like you rates. I mean, I get it. So it's like for them to get past just doing a little bit, and I mean, really, like 2 cuts out of 8 meetings, like that's really not them doing a whole lot next year, right. Especially if I am correct and the inflation data continues to improve and the speed at which it improves picks up, is going to get a little uncomfortable, because and this will be a big discussion with the funds rate, or with the natural rate. The Fed, when it gets to 2 and is kind of sitting at 2% inflation, it should be out of the way.
Right.
Whatever the federal funds rate is at that point shouldn't be pushing up or down on the economy. And, so we're not that far from 2, right? And so they've got to make an argument, we're not that far from the neutral rate. And maybe that's true. I am skeptical of that. So I think we'll have the progress they think they'll need to take a little bit more off, because inflation's come down. And I think there's a possibility of the labor market looking a little more wobbly, and they do have a dual mandate. And if it comes together like it did in the fall, where you have some very weak inflation data that's come in along with labor market data it's a little disconcerting. Well, you can get some more cuts out of that. And that's one thing they are not assuming. The right. Fed's labor market forecast for next year could not be more optimistic.
Yeah, what is it? I think they only, like, unemployment for the year is like 4.3 or 4.4. It's kind of like a nothing for the year. Do I remember that right?
So, and if that turns out to be the case, then okay, maybe there are 2 cuts, is it? But I doubt the labor market's a nothing.
Yeah. So you're thinking, again, you last time we spoke, I asked you what your favorite unemployment kind of reading is, and you just said, hey, watch non-farm payrolls, that monthly number. So just keep watching that.
And I think the unemployment rate is, I can't believe I said non-farm payroll. I can't, like, not even using my SOM rule uses the unemployment rate. No, I would look, I mean, the Fed clearly looks carefully at non-farm payrolls. I would very much look at the unemployment rate. The other piece that in the labor market that's going to be something to keep an eye on, though it's going to be a little trickier, I can't point to a particular series for it, is we will continue to see, and already have seen, some drop off in immigration to the country, and the increase in workers has been a really important theme of the past few years. I mean, Some of it has been disruptive and on other dimensions, but we're already seeing the immigration, the unauthorized immigration has slowed down. And of course, that's another big policy agenda is anywhere from much lower immigration to even deportation. So that could have some pretty, I don't think we'll see the most dramatic effects because I just think it's so disruptive on a business and a consumer level. But it's an aspect that labor supply piece is very important, and it's been in there in the last at least 2 or 3 years in terms of the economy growing so quickly and labor shortages behind us. So when you start to take that away, that could have some kind of surprising effects.
Well, let's close on this question. Do you see a recession in 2025, or we're just gonna, have a no landing or crash up, or what's Claudia's call for 2025? Recession or no?
No, I don't see a recession, with the caveat that for recessions aren't forecastable. I know people listen to economists and market people forecast a recession for like years on end, but like that's really not how this works. It's something that comes out, of left field that could blow up. And I can certainly think of some things that could blow up. I worry a lot about I'm not a like debt sustainability. That's all I think about, like the debt to GDP and all that. But I do worry about market crisis of confidence and sustainability and these tail events that aren't typical or forecastable. But it's like it has to be something pretty big. It has to be pretty shocking. The whole AI trade unwinding in the stock market. And it's like, I don't expect these things at all. Like, these are not my base cases. I don't think we should have them as base cases, but we should always be prepared for the unexpected. And that is typically what pulls us into a recession, though.
Love it. Well, you put out an amazing Substack. We have it on the screen now. It is at Stay at Home Macro. We appreciate you being here. Thank you for coming back. Happy holidays, Merry Christmas, Happy New Year. Claudia, you're amazing.
Oh, thank you. Happy holidays to you too.
Awesome. Take care.